sounds great, but even if you cut 20%, if Russia cuts 20%, and if Saudi Arabia cuts 20%, that nowhere near even begins to dent the demand destruction and oversupply that we're seeing.
Yeah, good morning, Alex. Great to see you again. We started with numbers. We thought there's going to be a supply-demand loss of about 10 million barrels a day. That number's up to 20, and I've heard some analysts say it's as high as 25. We agree with you, but we need to get away from $6 oil. As you know, yesterday, the oil in the Delaware from all the new wells coming on is getting $6 a barrel. In the Midland Basin, it's $12 a barrel. Something has to happen, and there are estimates that will probably shut in about 10 million barrels a day in the world by IHS. That came up yesterday, and oil is being shut in around the world. Now, what we're doing is asking about fairness. The fairness question in the state of Texas is that some producers will not be able to sell their oil at all, in my opinion, over the next several months. The majors will be able to sell to the refineries. Pioneers of the world can export our crude oil, but we want the Texas Railroad Commission to step up to the plate and treat everybody fair with a similar cut in production.
I guess the counter to that is, Scott, is, why? I mean, many analysts say that the shale industry should have been shaken out in 2014, 2015, but the capital markets were still open, and you guys really do need consolidation, even though the assets are still good. So why prolong that?
The leverage, you look at the 74 independents, I stated recently that there'll probably be only about 10 independents that really survive and will have a great balance sheet. 64 of them will have debt to EBITDA of about 5 to 1 if we see the current strip play out like it is in 2020 and 21. And so there will be no consolidation because people do not want to buy companies that have too much debt. And so there'll probably be only 10 independents left. What's important is energy security and energy independence. I don't want to get back, since I've been in the industry for over 40 years, I don't want to get back to importing 60% of our crude oil from the Middle East and be highly dependent upon Russia, Saudi Arabia, and Venezuela to supply our gasoline needs for the next 20, 25 years.
So let's just play it out and say that the Texas Railroad Commission says okay, the Saudis say okay, Russia says okay. Does that mean that prices are going to rise to what?
I think that there's some type of uniform cut, and also Alberta is looking at it from Canada. Also, we're talking with North Dakota. North Dakota doesn't have the right to prorate, but they are looking at stopping all flaring. There's estimates that would cut 10% of their production. We're talking to the state of Oklahoma. They have the right to prorate. But it could raise the price back away from $20, maybe back up to $30. And so $30, we saw about a $20 price drop after March 6th from the time that Saudi and Russia blew up the meeting in Vienna. And we've seen about a $20 drop. We need to get at least 10 of that back. And so I think that's probably the best guess if there is some type of coordinated cut.
What is the appetite among your peers for that, among all the different players? Like, obviously, you and Matt Gallagher, who runs Parsley, are in really good positions. But what about some of the other guys that you're talking to? Would they be willing to do something like this just to get it up to 30?
I think companies, before last Friday, we had probably many producers did not want to prorate because their argument was they want a free market. Our argument back, there hasn't been a free market in oil. The Texas Railroad Commission prorated oil from 1929 to 1973. OPEC took over around 1960. They're having their 60th anniversary this year. They've been prorating oil since 1960 for about 60 years. And so with what happened Friday night when purchasers all over Texas told people to stop completing wells, you're going to have to reduce production, that I think there's a groundswell that's happening primarily with independents, with royalty owners, that something has to be done, and it has to be done fairly. If not, the small and medium producer will not be able to sell their oil, I predict, for several weeks to months until this virus ends.
Well, you mentioned earlier sort of $6 pricing. We've seen negative pricing probably in some areas. Bakken oil selling at $10. At this rate, how quickly, though, will we see production naturally shut in, regardless of any kind of quota?
Yes, there's about 900,000 barrels a day of what we call marginal wells in the U.S. The average operating cost is probably about $25 a barrel. I predict most of those will be shut in anyway, so we'll probably lose about 900,000 barrels a day of our 13 million barrels a day through marginal wells. As we get, the average operating cost of a horizontal well is somewhere between $5 and $10. You have to look at a company's balance sheet, and you have to add the G&A cost, the overhead cost. You have to add the interest on their debt, and then you look at their operating cost. When you look at that, that number is around $10 a barrel for most companies. So they really should be shutting in a lot of their wells because they're going to have negative cash flow. This year, a lot of producers are protected on hedges, but those hedges roll off. There's estimate those hedges are about $15 to $20 billion this year. But next year, very few companies are hedged. So the disaster really happens going into 2021.
So if, let's say, producers say, you know what, Scott, I'm not going to do this with you because I need to get any kind of cash flow that I possibly can, would you go it alone? Would you cut 20% of your output?
Well, I think we're going to have to cut already because the producers, the purchasers are warning us already. Pioneer, you're going to have to cut. What they don't know is what that number is going to be. So I think some producers are going to have to cut 10%, some are going to have to cut 20, some are going to have to cut 30, and some will not be able to sell their oil because they don't have the power or the stroke or the contracts to get their oil to the Gulf Coast. So there's going to be all types of ineffectiveness or unfairness among all the producers in the state of Texas, and that's why we want the commission to regulate that process.
So is that a no that you won't cut if the 20% you cut less if others don't agree to step in with you?
Well, no, we are going to have to cut because purchasers will not be able to take our oil. So we'll